In Chapter 4, Common Stock, Warren Buffett offers a comprehensive look at the role of common stock in corporate governance, shareholder relations, and capital allocation. Buffett emphasizes that managing a company's stock goes beyond meeting quarterly earnings expectations. It requires careful strategies to attract long-term shareholders, optimize transaction costs, and make informed dividend and repurchase decisions. This chapter is divided into several critical sections. The bane of trading transaction costs, attracting the right sort of investor, dividend policy and share repurchases, stock splits and trading activity, shareholder strategies, and Berkshire's recapitalization. The bane of trading transaction costs. Buffett starts by addressing the impact of transaction costs on investors. Every time stocks are traded, transaction fees and bid-ask spreads can erode investor returns, particularly for frequent traders. He warns that excessive trading, often driven by the desire to time the market or react to short-term market movements, diminishes overall returns. Buffett advocates for a buy-and-hold strategy, where investors hold onto stocks with sound fundamentals over the long term. This approach reduces transaction costs and capital gains taxes, allowing for greater compounding of returns. Buffett's critique extends beyond individual investors to financial institutions as well. He points out that institutional investors, especially mutual funds, often trade too frequently, motivated by the need to appear active or to churn portfolios, thereby increasing fees. His advice: minimize trading as much as possible and focus on owning businesses with solid long-term potential. Attracting the right sort of investor. Buffett believes that companies should prioritize attracting the right sort of investor, those who understand and support the company's long-term vision rather than those who chase short-term gains. For Buffett, a company's stock price should reflect its intrinsic value, not temporary market enthusiasm or pessimism. He prefers investors who are committed to holding their positions over time, as this aligns with Berkshire Hathaway's approach to sustainable growth and value creation. In Buffett's view, companies often try to increase their stock prices by appealing to short-term traders or speculators, which can create volatility and discourage serious long-term investors. He argues that a business should focus on fundamentals rather than stock price manipulation. By attracting a base of long-term investors, a company gains stability, which in turn encourages effective management decisions that focus on long-term success rather than short-term market reactions. Dividend policy and share repurchases. One of the most important parts of Chapter 4 is Buffett's perspective on dividend policy and share repurchases. Buffett explains that dividends and buybacks are two primary ways companies can return capital to shareholders. However, he believes that these decisions should be based on a thoughtful analysis of the company's long-term financial needs and investment opportunities, rather than simply trying to meet shareholder expectations for consistent dividends. When it comes to dividends, Buffett advises caution. Dividends can be beneficial for shareholders seeking income, but they may also limit a company's ability to reinvest profits into growth opportunities. In many cases, Buffett favors share repurchases over dividends, as buybacks reduce the number of outstanding shares and can improve per-share value for remaining shareholders, assuming the stock is repurchased at a fair price. However, he warns that repurchases should be carefully timed and executed when the stock is undervalued, not merely as a tool to boost stock price artificially. Buffett's stance on share repurchases is a cornerstone of his capital allocation philosophy. Companies should return cash to shareholders only if they lack better investment opportunities that can increase the company's intrinsic value. Through this lens, dividends and buybacks become part of a disciplined approach to capital management rather than tools for placating shareholders. Stock splits and trading activity. Buffett is famously opposed to stock splits, a tactic often used by companies to make their shares appear more affordable. While stock splits can increase liquidity by lowering the per-share price, Buffett argues that they often attract the wrong type of investors, those interested in short-term gains rather than long-term value. By keeping Berkshire Hathaway's stock price high, Buffett aims to attract serious, committed investors who understand the company's long-term objectives. He cautions that stock splits can fuel speculative trading, which introduces more volatility and detracts from the business fundamentals. His view is that a company should focus on building intrinsic value and allowing the stock price to reflect that growth organically. In the long run, Buffett believes that genuine investors will appreciate a high stock price as a reflection of a strong and well-managed company. E. Shareholder Strategies. In this section, Buffett discusses the strategies that shareholders should adopt to maximize their investments. For him, the key to successful investing is understanding the fundamentals of a business rather than following market trends. He advises shareholders to focus on companies with a solid track record, strong management, and a clear path to sustainable growth. This approach aligns with his philosophy of buying wonderful businesses at fair prices and holding on to them for the long term. Buffett encourages shareholders to adopt a long-term perspective, which means looking at stocks as part ownership in a business rather than merely as trading instruments. This mindset fosters a more disciplined approach to investing, where decisions are based on the quality of the business rather than short-term price movements. For investors, adopting Buffett's approach means staying patient, avoiding speculation, and focusing on companies with proven value and growth potential. Berkshire's Recapitalization. The chapter concludes with an example of Berkshire Hathaway's own approach to stock issuance and capital structure, known as Berkshire's Recapitalization. Buffett explains how Berkshire issued Class B shares as a way to allow smaller investors to participate in the company without significantly affecting its stock price or altering its investor base. This decision was made carefully, with the goal of aligning the interests of all shareholders and preserving Berkshire's long-term focus. Buffett's recapitalization approach reflects his commitment to attracting the right type of investors. By creating Class B shares, he offered a more accessible entry point for smaller investors who were aligned with Berkshire's vision, while keeping the original Class A shares intact for long-term investors. This approach minimized dilution and preserved Berkshire's culture of responsible long-term investment. Recap of chapter highlights. First, transaction costs. Buffett warns that excessive trading can erode returns due to transaction fees and taxes. Minimizing these costs allows for greater compounding of returns, which is essential for long-term growth. Second, attracting the right sort of investor. Companies should focus on attracting long-term investors who align with the company's mission and values. This strategy fosters stability and encourages effective management decisions. Third, dividend policy and share repurchases. Buffett suggests that dividends and buybacks should be based on the company's long-term financial health rather than meeting shareholder expectations. Buybacks can improve per-share value if done when the stock is undervalued. Fourth, stock splits. Stock splits often attract speculators and increase volatility. Buffett opposes them, arguing that they detract from the business's fundamentals and do not add intrinsic value. Fifth, shareholder strategies. Shareholders should adopt a long-term perspective, focus on fundamentals, and treat stocks as ownership stakes in businesses. This approach promotes disciplined investing. Sixth, Berkshire's recapitalization. By creating Class B shares, Berkshire allowed smaller investors to join without altering its investor base. This move reflects Buffett's focus on attracting serious, long-term investors. Conclusion. In Chapter 4, Common Stock, Warren Buffett shares valuable lessons on managing stock and shareholder relations from a long-term, value-driven perspective. He emphasizes that companies should aim to attract investors who align with their mission and vision, focusing on strategies that create sustainable growth rather than short-term stock price manipulation. Buffett's approach to dividends, share repurchases, and stock splits is guided by a commitment to maintaining intrinsic value and discouraging speculative trading. His views on capital allocation reinforce the importance of a disciplined, long-term approach to managing company stock, prioritizing steady growth over short-lived market trends. For shareholders, Buffett's insights underscore the value of patience, discipline, and a focus on fundamentals. His philosophy encourages investors to view stocks as ownership stakes in real businesses, requiring the same level of commitment and attention as any other significant investment. By adopting this approach, both companies and shareholders can foster a more stable, profitable relationship based on shared values and a mutual commitment to long-term success.
Thank you for watching Share this with friends and family, and please subscribe.